Let's take a deeper dive into what's been happening with the market action this afternoon with our market guest, Omar Aguilar, Schwab Asset Management's CEO and CIO. Now, it did seem like equity markets were digesting and normalizing in terms of how they reacted to things like the Russia-Ukraine conflict as well as the Fed rate hikes. So what do you think we're seeing today then as the markets are heading south again?
Well, it's interesting to just see the different signals we get from different markets. Equity markets seem to be taking a little bit of pause for a big rally we have seen, just in the last several sessions. And, after sort of hitting a bottom and then recovered quite substantially and pretty fast, which would people suggest that investors in the equity space may be thinking that things are getting better. However, when you see the actions that we see on the fixed income side and on the bonds, we see the level of volatility and activity that tends to show that things are not getting any better. So these sort of conflict between the markets seems to be very confusing for most investors. I would probably think that the actions today has really more to do with people trying to position for the end of the quarter as opposed to anything that is driven by the economy or fundamentals.
Omar, given everything going on out there, you've got geopolitical activities, you've got the price of oil, you've got inflation, Fed hikes coming, certainly looking at probably 50 basis points the next meeting. Is this just the type of volatility you expect over the next several months?
I would probably say that this type of volatility will be here for quite some time. And, this is not very uncommon as you think that we're moving from these mid-cycle economic, views to these late cycle very quick. I would probably think that the Russia-Ukraine war has actually accelerated this path and clearly has created some conflicts for the Federal Reserve in their tightening cycle. So I think that component of moving into that late cycle, that basically we have been talking about recession, we have been talking about slowdown, we have been talking about the potential for a soft landing as opposed to avoid the recession. When you put all these pieces together, clearly the big, component that will stay with us will be that volatility in both fixed income and equities will continue to be part of the game.
There's an outsized impact to U.S. companies when we hear or see headlines about China closing down, or at least in processes, trying to get its hands around the COVID spread there and what that could mean for shuttering the availability of products or services for U.S. companies that have looked at the region for growth versus the economic impact that could take place in Europe, in the EU, as a result of war that is more likely to impact them directly. And so can you compare the two for us and where some of the companies that have based a lot of their growth ambitions around globalization may need to be wading through or evaluating both of those scenarios quite handedly?
Yep, good question, and certainly international markets are at in that particular juncture of understanding the different implications. Starting with your question about China, there is a very substantial slowdown in economic growth of China, which is, as you know, a big outlet for growth in emerging markets overall. So the impact of economic slowdown, the transition of the Chinese economy, as well as the issues that they still have to resolve on the real estate side, together with their policies to curtail COVID and the ongoing restrictions that will put even more pressure on growth, that has a significant implications throughout the world. But in particular, I would probably say the supply disruptions that we already have. So if you think about the reasons why we started to get higher levels of inflations in the US and globally was as a result of initially the aftermath of the COVID supply chain disruptions. Well, these particular actions on the Chinese government will just exacerbate that particular issue for many firms. And what that means is we'll increase the cost, will increase the timing lags, and therefore the potential price impact to those goods. On the other hand, you have the situation with the crisis and the impact of commodity prices, particularly in Europe, that is not going to go away anytime soon. I think regardless of where the result of the escalation or de-escalation of the war, the dependence of most European countries for natural gas in particular is going to take some time for that to be resolved. And as such, the level of inflation pressure will stay, for quite some time. So I think the common common ground between the two is that we will have more sustained inflation, whether it's because of supply chain disruptions or ongoing pressure on commodities that will affect, for the most part, Europe.
So then to that point then, Omar, as you mentioned in your notes, the transition of a goods to services economy has slowed down significantly as the risk of a recession has increased. How does that inform your investment strategies going forward during this period?
Yes, and that is probably the most critical part of where we are in this cycle. As we normally have in general cycles, usually it takes time to go from that mid-cycle to that next bit of the cycle, which means that it will take the Fed a little bit more time for them to, increase interest rates because inflation tends to be a little more controllable. In this particular case, the consensus out there is that the Fed is trying to catch up to inflation, and hence the aggressiveness that they have to go in terms of raising, rates, faster to curtail inflation. What that does is that what we all thought was going to happen is that we will transition from buying goods as we were all working from home to now going through services as people will take vacation, as people go out and people drive during the summer, that we all thought that transition was going to probably reduce the amount of inflation pressures. Well, that seems to be questionable now because it's going to take a little longer for that to happen, as people obviously don't feel that comfortable having to go and put gas in their cars and drive around because gas prices are very high. And therefore, the potential for more pressure on wages to try to offset a little bit of that inflation. So that transition may take some time and will have an impact on the timing for the Fed, as well as just what the consumers have. Now, the last thing I would say on this point, though, is that consumers still have a significant amount of savings, and that could be the little bit of the silver bullet that allows these, to be less of a problem and maybe, get that transition to services a little better.